Sometimes doing Roth conversions aren't as obvious as you might think or what I would like to see. And when it's not, you're like, oh, it's a challenge to make it work. So I'm working with a guy, and it's kind of like I can see both sides of it. It's just not as crystal clear as what I like. And I'm going to share with you some thoughts on this. I've been thinking about this quite a bit because it's just, man, you're sitting there thinking, we got to be able to make this work somehow. It's tough. So let's look at the dashboard of, we're going to look at Kathy and Kenny Cali. They're in California, so we're going to call them Cali. Got a net worth of 1.23 million, which consists primarily of Kathy's 401k. Got $1 million in a joint account and a small value home. All right, because California, obviously that's fake, but you get this. The home has no relevance to this. All right, so what we're going to do, let me just go to the profile here to show you something real quick. We're going to have, and again, this is just my fake account, all right, but I think it's pretty important to see. So Kathy is 63, Kenny's 65. They're both retired. They both have some Social Security income. Kathy's got a pension of $20,000 a year, which will stay for her life, and then it'll be a 50% survivor. They're not saving anything simply because they're retired. All right. Their net worth, again, consists of the investment accounts, but it also consists of this account right here, this Vanguard S&P 500. And if you see, the value is 138, but they have a cost basis of only $50,000, which will play a role. And then they have the balance index fund for Vanguard. So the question is, should they convert? All right, and so what we're going to do is what I always do in these things I keep in my running account is I have a 401k distribution at the ready to show you what happens when they convert. All right, so first we're not going to convert, and we're just going to look at the tax tables here. And what you can see, and again, if I may, California isn't the bugaboo, my friends, that everyone thinks it is. In fact, the guy I'm working with right now is in Utah, and Utah is significantly worse. It is just significantly worse than California. California is just not that bad from an income tax perspective. So you don't need to flee the state for income tax, and you might want to flee for other reasons, but it's the feds that get you. So what you see here is from 64 to 70, they basically have no taxes whatsoever. Then they have RMDs kicking at 70, their taxes go through the roof, and now we have this big tax hit. It goes from 15.7 to 20% simply because that's the widow's tax trap. And if we look at it on the cash flow perspective, you can see that here, watch this. This is what drives me crazy. So we'll see this is the total income flows right here. And at 88, when Kenny dies, they had $221,000 of income. And then the next year, when he's dead, they have $195,000 of income. So they lost, what's that, $25,000 of income divided by 221. So they lost 11.5% of income, but their taxes went up by $16,000. 50. So the tax went up by 32%. They lost $11,000 of income. The tax went up by 32%. Welcome to the widow's tax trap. All right, so here we haven't done any conversions at all. And what I want to share with you is we're going to look at the first result will be with not doing any conversions. I did my little trusty spreadsheet. Was that 100? Yeah, it's 100. So we want to go to no conversions at all. All right, so here, just make sure. Yeah, no conversions. Let's just see. Yeah, all right. So what's happening here is this is the taxes from not doing any conversions at all. And what you'll see is they end up paying about $812,000 in taxes from not doing any conversions. And then at Kathy's demise, she leaves her heirs roughly $5 million of total net worth, which includes a house, which is tax-free, which includes a taxable account, which is also tax-free because all the distributions that were coming out of the 401k that she's not spending go to a taxable account. And we were paying taxes on that. She was paying tax on that in terms of capital gains and dividends, and that's reflected as $812,000. But then she leaves as non-qualified assets, which should be taxable. And so what we do is we're just going to say her heirs are going to get that times 0.7. We'll say they have to pay 25% on taxes on that simply because they're going to have the Secure Act passes, and I think it's going to, and signed into law, the heirs are going to have to zero that out within 10 years. So they'll have to get, about $150,000 a year they'll have to take out as income. They'll have to declare income about $150,000 a year for 10 years of taxes, which will reduce this 1.4 million by 1.183. So let's do this. We're gonna go equals this plus this plus this. So she's totally going to leave $4.57 million of net worth net of taxes. And again, assuming a 25% tax bracket. So she paid $812,000 and she's leaving 4.579. So if she does the $100,000 a year conversions, what happens here? Well, here she pays $450,000 and leaves $4.865 million of tax-free net worth. So, significant. She pays, basically $400,000 of less in taxes, and she leaves $300,000 more of net worth. I mean, that's a good deal, right? Well, let's take a look. So, when they're on Medicare here, their total income flows are $38,000. So you can see there's just not much taxes here. $38,000. So they're not paying any Medicare increases on premiums, but their total taxes, total inflows here are $123. But they got to pay these taxes out. So bear with me just a second. We're going to go to accounts, withdrawals from accounts. So what you'll see here is from their 401k. Yeah, so they're pulling. Oh, it's still not so bad. Yeah, they're basically allowing their taxable account to pay the taxes. Essentially, they're not pulling from the 401k in which to pay the taxes. So that's good. They're pulling from their taxable account. But anytime they're pulling from their tax account, it's cost them taxes because they have growth in that taxable account. If that makes sense. So that's good. Withdrawals from accounts. We go net flows, and here comes a 401k distribution, so they got to take their RMDs, which is what that is. Okay. All right, so good. That's nothing wrong with that. Okay, RMDs right there. Yeah, and so those RMDs are going into the taxable account. They're using the taxable account in which to pay the taxes because they don't have any cash. All right, so that's good. That's pretty good. So they're never their expenses, their total inflows are never above. Yeah, they'll never be above the realm, most likely, of the Medicare IRMA, the income adjustments for Medicare Act. So they're never going to pay higher Medicare premiums under current law for Part B, Part D, and whatever Medigap. When Kathy survives Kenny, she'll be in a higher tax bracket for sure by then, and have to pay the IRMA. All right, so let's look at if we do these Roth conversions. It's a tough one, man. This is still sometimes one in the hand is better than two in the bush, and I wonder if this is the case here. And it's a tough one. There's no right or wrong answer when you're making this kind of money. So we're going to do convert to Roth at $100,000 a pop, and what we'll see here is a pretty significant tax here on the front end, and then in the back end, no taxes whatsoever. So let's take a look. A little bit of tax. So California tax are gone, Fed's tax gone, the widow's tax trap. And the reason why that's happening because Social Security, plus the fact that she has a pension, small pension. But anyway, let's look at cash flow. It's a tough. That's what I'm working on with this guy. It's like, man. And so what we have here is you got let's go to investment accounts. Ending balance by account. So you can see here, yeah, she still has some money in her 401k up until she's 70 and up until the age of 2033. And then her regular account is growing because she'd had. Well, let's take a look. Let's addition to accounts. Yeah, so basically, not much. All right, so I'm kind of talking to myself here real quick. Cash flows. Yeah, okay. These are the reinvested dividends and capital gains, but still, and let's take a look at what the ending balance is, ending balance. So when she dies, she doesn't leave anything in taxable account. It's all in a Roth, which is wonderful. Let's take a look at what the summary looks like again. Her income flows for the conversion. See, it doesn't look like much here, but if we look at the 1040, I think it's going to look different. So we're going to look at this 1040. Yeah, well, even that's not bad. Okay, so here, she's not on Social Security. She has She got to take $120,000 out of her 401k in which to pay the tax on. the 401k conversions to Roth. So if she wants to put 100,000 in Roth, it's costing her 120,000 bucks. Let's go to 2024, and here it's still pretty close, but they're still not above the MAGI, the modified adjusted gross income, when it comes to paying more in Medicare premiums. And here, I mean, again, now she's got Social Security, and here, no, still not there. All right, cool. So it doesn't look like she ever pays MAGI. Her MAGI, modified adjusted gross income, never makes her pay more in taxes for or more in premiums for Medicare. That's good. Go to 2000. All right, it's close, but still good. No, they're not. They're not. That's fantastic. And then when they stop doing the conversions, yeah. All right, so what's my concern here? That's a tough one. It's just, I mean, you're essentially, when you're paying the tax up front, it's costing a bulk of tax up front. Why we got that? Oh, because she has a, where's that? So hold on a second. That's going to be in 2000. Let me see why we got even that little bit of taxes here. Hold on a second. Let me go to tax. Go to details. Where's even that little bit of taxes coming from? Let's go to 2030. That's all tax free. Social Security. She got a little bit of pension and Social Security. So her Social Security and pension is giving her a little bit of taxes. Okay. Total tax. That's not right. All right, hold on a second. Let me go. There we go. Okay, cool. So she's got, there's her pension. There's her taxable Social Security. Okay, it does. Her provisional income is such that she still has $1,500 of taxes because her pension is basically wiping out, for the most part, their standard deduction, personal exemption. Not quite, but enough where she has total Social Security coming in. It makes her have a little bit of tax. So that pension's hurting her in this regard. Anyway, the issue that comes to me is, all right, she can save, $400,000 of taxes and leave a couple $100,000 of extra net worth. But the drawback is she's going to pay the taxes here in which to do it. And neither of these are being affected by modified adjusted gross income when it comes to Medicare premiums. But the issue comes to, it's a tough one, man, because you're saying, look, because your pension, you never have no taxes. It's still pretty doggone low. You'll never have high enough taxes where you're going to pay modified adjusted gross, or to have IRMA pay increasing Medicare under current tax law. I think I'd probably still do this. I think I would do the Roth conversions. Let's do one other thing here. Let's change the account, because what we're doing here is we're using the modified, the account being the, I think I was using the balance fund, which is that's still pretty good, 5.9%, which is even a more aggressive, it gives us a better return than our aggressive accounts for our target allocation. That's not a target, it's still pretty good. So I was thinking, what if we made it more stocks? Because once you have it more stocks, you have less money. If you have to take money out from your accounts in which to pay the taxes, you have less money in your account in which to grow. This still looks pretty good, man. I think I still recommend old Kathy and Kenny do this. I like the idea of having less tax in the future. I just like it because the tax rates in the future are going to be fluid. I don't think there's going to be anyone just says explicitly we're going to raise your income tax. I mean, they're going to follow the Mondale strategy to it. They won't win. We know they're going to, but they're going to do it stealthily. And if you have money in the Roth, and then it'll look at, if you have money in the Roth, right, and you got your tax bracket or your 1040 reads like this as opposed to something else. If I can get this guy to open for me. So let's go to 2035. This is what our tax bracket looks like. It looks like we have $51,000 of taxable adjusted gross income, even though we have $93,000 of Social Security benefits, $20,000 of pension. So it looks like we literally have basically $15,000 of income. But because standard deductions, personal exemption, we only have adjusted gross income of $51,000. So that is not going to put us in the category to be hit hard by Bernie Sanders and Elizabeth Warren. Because you don't see it. The feds do not see it. They don't know on the 1040 that you have in your retirement account at that point, that's 2035. Time check. Okay, gotta go. 2035. They don't see that you have $2 million in a Roth. I think you still got to do it, man. I like it. It's tough. That's not as cut and dry. It's not cut and dry, but this is why I got to do the planning, and you have to have some thought process on this. All right, don't forget to smash, and we'll see you next time.